Now, in the next part of this course, we're going to talk about swing structure. Now, swing structure is a key component of your trading because of this is what is going to simplify everything. It gives you a region of price to only focus on. Now, um, the way I view my swing structure or my swing structure is formed when I have a liquidity sweep, then a break of structure, and some kind of internal liquidity. When I get this whole thing, these three concepts, this becomes my this becomes my swing structure from this low to this high. Let's make this black and make it to this high is my swing structure. And this is the point in price that I'm interested in. I'm not interested in anything apart from this place, anything outside this range. Remember, this is a break of structure, always remember it. And this is in liquidity, this is a liquidity sweep before the break of structure. So when we have a liquidity sweep and a break of structure and there's some form of liquidity inside that place, and there's some form of liquidity, then that is I have that is my swing structure, and I can decide to draw my premium and discount from the low to the high, and more this low in this case it become my protected low, and my protected low is basically the point in my swing that I expect price not to take out. Is a point in my swing that I expect price not to take out. We're going to go over to this in a bit. So this becomes my protected low, and this is my low resistant liquidity run. So it's a place that I expect price to easily take out. So I can also map my premium and discount like this from this low to this high. Now, I hope you guys understand what I'm saying. Once again, for my range to form, the way I view my range, or some people call it swing structure, some people call it dealing range, but the way I view it, I want to see a break of a liquidity sweep, then a break of structure, and there should be some form of internal liquidity in that range. That range must include an internal liquidity. So when I see these three things, I can mark the low to the and the high as my range. The low in this case, because it's a bullish range, is my protected low, and this is my low resistance liquidity run, right? And in some cases, this thing can form. Notice something, we only have a single break of structure, but there are cases where we have multiple break of structure that form the range. And when is that case? Now, remember I told you guys for for me to frame my range, my swing structure, I'm looking for, let me move this a bit. I'm looking for what? A liquidity sweep followed by a break of structure. Then I want to see some kind of structural liquidity or internal liquidity around this point. But in this case, price did not form any internal liquidity. So what the price did instead, price it came back, retraced, and break the next structure at this point. We had a second break of structure at this point. We had a second break of structure at this point. In this case, this now finally become my liquidity, and I can map my range from this low, and this become my protected low because this is the low that swept liquidity. I can now mark my range from this low all the way to this high. Same thing we did here. We can let's do it for clarity's sake. We can mark it from this. We can mark my range from this. What is wrong? Click. Stop messing with me. We can mark it from this range to this high. Now, this is my premium, this is my discount, right? This is my premium, this is my discount. Whenever I'm selling, I want to be selling in premium. If I want to be buying, I want to be buying in discount. And this is basically how my range is formed. This is how I view my range. There are two, my swing structure. Sometimes I call it my dealing range or my swing structure. So this is how I view it. This is the approach I used to that I take to be able to mark my range, right? Once again, what is swing structure? A swing structure is gives you a swing structure is gives you a segment of price to focus on, right? So in some cases, what most people do is after they see a break of structure from this high to this low, they mark it as their swing structure and they can draw their fib like this. But I like to incorporate liquidity, or rather internal liquidity and liquidity sweeps and internal liquidity to form my range. So as I told you guys, for me to frame my range, I like to see one, a liquidity sweep followed by a break of structure of the main structure. This is the main structure. Let's say the market is, I will show you more examples, don't worry. So after a liquidity sweep and a break of structure, I want to see some kind of internal liquidity that is inside. There must be internal liquidity inside that range. This is the range we are working with. There must be internal liquidity. Then when I get that three criteria, I can mark my range to this high and this low, from the low to the high. Now the low is my protected low because it's the area that I don't expect price to take out. Why the high is my low resistant liquidity run, is the area that price is likely going to take out. You get? Now, remember I told you guys we must see three criteria. I want to see a liquidity sweep, I want to see a break of structure, and I want to see there must be liquidity inside that range I'm about to mark. But in some cases, there is not going to, we had our break of structure, our liquidity sweep, followed by our break of structure. Now, in this case, there is no liquidity in this range. I should have marked this range like this because we have a break of structure, a liquidity sweep, a break of structure. So I would have marked this range like this. But no, I can't mark this range like this because of there is no liquidity in this range I'm about to mark. So I must wait for price to form liquidity. So what I'll wait now is I'll wait for price to do its thing. So price now, in this case, price came down and break the next structure. As it came down and break the next structure, now price, now this next structure, this last low now becomes a liquidity. This break of structure and internal liquidity. So now all our criteria have met. Now we can now mark the low of this as our protected low, mark the high as our low resistant liquidity run, and we can draw our fib from this high to this low. Do you understand? Do you understand? Do you understand? I believe this is clear, but don't worry, I'm going to give you a couple of life example, obviously, and this is going to make more sense. Now, give me a minute of silence. Let me see if there is any other thing I need to explain or any way I can make this thing more, um, more clear for you guys, so you guys can understand it. Give me a minute of silence. Wait. Yeah, that's basically it. So let's go to live exam, live chat. Okay, let me tell you guys something. So why do I need all these criteria now? I want all these criteria because I want to be sure that this range is high probability and price is going to react from it. So if I decide to skip this thing out, or let's just say that I decide to mark from year to year, there's no internal liquidity. In some cases, what price is going to do is going to come down and take out this place because of price always need liquidity. It might not respect this demand zone right here. Why? Because of there's no liquidity. But when there's liquidity there, I can now trust that this demand zone that is in this my range can work because of it's a stacked conference. Price is going to take out that demand, this liquidity, tap into the demand zone and skyrocket. That's basically it. So once again, to wrap this whole system before we go to the live example, I told you guys that swing structure gives you an area of price to focus because of price is if you don't structure your this and work, price is going to the whole market is going to look very confusing, up down, this you don't even know where to focus on. So it gives you a focus, right? And I told you guys that There's a particular way I like to view my swing structure. Something that is um, that everybody does, or the way people do their swing structure is like this. This is their normal market structure. When they see a break of structure, so basically, this is they see a break of structure. This is their range. How people market like this from their this end to this end. So this is their high range high. This is their range low. And this is good, it's completely fine, but me, I like to add more confidence to my trading. I like to add more. And what is that I add? I want to see them. There must be one, a break of structure. Let's go back to this page. I want to see that one, there must be liquidity sweep before that break of structure, and there must be internal liquidity. And let me show you guys that thing. Let's say we are reading market structure. Remember what I told you about market structure? Let's say we are reading market structure. Higher highs, higher lows, higher high, higher low. Now price does something like this: swept liquidity, then formed something like this and break structure, then start retracing. Now what do we have here? This is our current price. I told you guys um swing structure, or our range gives us our swing structure give us an area to focus. All these things are price movements. And so for you not to get confused, the first thing I like to do is to mark out my current range. Now for my current range, what did I told you? I want to see first a liquidity sweep. After this liquidity sweep, next I want to see a break of structure. This is my break of structure. Now I want to see that there's some form of liquidity that is inside that range. Now from here, after I see these two criteria, my this thing can, from year to year, can be my range. But one more criteria I want to look out for is I want to see that there's some form of internal liquidity in that range I'm about to mark, because I'm about to mark this range. So I want to be sure there's internal liquidity. Then when I see these three criteria, I can now mark my range. I can now mark this as my range. This is my range low, and this is also my protected low. Now this is my range high, and this is also my low resistance liquidity run. Low resistance liquidity run. Let's put that at the top. So if I want to mark my premium and discount, I will mark it from this place to this place. Notice something: I'm not marking it from this low. I'm not marking it from this low to this high, from this low to this high, which is what most people do, and it's good. It's complete fine. I'm not criticizing anybody's approach. It's good. But my approach to marking my range, I like to incorporate liquidity sweeps and liquidity resting zones. I want to see that price swept liquidity, and I want to see that there is a liquidity inside the range I'm about to mark. I hope you guys understand it. So now this is one way this our swing structure can form, right? But I told you guys that there's another way this our swing structure can form, right? Let's say that um let's get rid of all these things. Let's say that price, let's say we have something like this. So what do we have here? No. Oh, give me a second, give me a second. So what do we have here, right? So in this case, we have scenario where price, what do we have? We are trying to mark our range, right? So price was bullish, forming higher highs and higher lows. So price does two things: it first and strip liquidity, and then second thing, it breaks structure. Now we are trying to mark our daily range. For me to mark this daily range, I won't mark it from this. I can't take this as my daily range, from this high to this low as my daily range. Why? Because I'm waiting for one more criteria. Because of in this case, price did not form any liquidity. I want to see liquidity in this range I'm about to mark. This is the range I'm about to mark. After I see this liquidity sweep and break of structure, this is now the range I'm about to mark. But I can't mark this range until I see a liquidity sweep. So what I'll wait for instead is that I'll wait for price to maybe do something like this, do something like this. So when price does something like this, now our criteria has been complete. We have a liquidity sweep, a break of structure, but in this, and then we have internal liquidity. So now we can mark this low. Our range will now be from this low all the way to this high is now our range. So notice something. We did not mark from this low to this high as our range. No, our range is now from this place to this high because our range must incorporate liquidity. This is as simple as I can explain it. If I want to mark my premium and discount just so I can know where I should be selling and buying, I can mark it from all the way to this high to this low. So what is the difference? The first one only gives us just one break of structure, while the second one gives us two break of structure for it to be formed. So if price luckily form the liquidity first before the break of structure, then we don't really need for price to create the next swing. This can already be our low because of why. This can already be our range because of we already have all the criteria we need, which is one liquidity sweep, a break of structure, and there's already internal liquidity inside this point. So enough of talks. Let me look for this. Let me show you guys this in the live example. Now we have drawn many things. Where is my chart? Now, all this drawing, how do I get rid of all this drawing? Um, Give me a second. Now, this is an example of what I'm talking about. Now, notice something. Let's try to get our swing structure and also our and mark our premium and discount. So that's what we are going to be trying to do. Now, notice on the price it was in an uptrend, a break of structure, retracement, break of structure. Now, let us focus on what price did here. What the price did, or if I want to frame my swing structure, I want to see the first I want to see is a liquidity sweep. After a liquidity sweep, I want to now see a break of structure of a key structure. What is a key structure? When you are reading the market structure, that last high that price formed before the retracement, that is the key structure. There are going to be some minor structures inside that range, but don't get confused with it. It's not when price broke this one high that is forming a break of structure. No, this is the main high, right? So that's what I mean by a key structure. So after the first thing we are looking for is a liquidity sweep. The next thing we are looking for is a break of structure. And one more thing we are going to look for, we want to see that there's liquidity inside that range we are working with, right? So now this is the liquidity inside our range. So when we see these three criteria now and price forms a peak, we can now mark this low. Let's get rid of this. We can now mark this low as our protected low. We can mark our range from this low all the way to this high, right? And this low becomes our protected low. Is a low that we expect price not to take out, and this high becomes our low resistance liquidity run or external range liquidity. So this is the high that we expect price to take out. Now if we are to map our premium and discount, we mark it from the top to the bottom to the top. Anything above this place is our premium, anything below this place is our premium. Now what's the difference? Notice something, we didn't mark our premium and discount from this one low to this one high like usual. Why? Because of we incorporated liquidity. So this is one example. Let me look for another example. I think this thing is becoming long, so I don't want to bore you guys, so I'm going to just pause it Let's pause it while I go look for a new example. All right, so this is the next example we are going to be exploring, marking our range, our swing structure once again. So now notice something. We are trying to read market structure. The first thing is we see price in a downtrend, lower low, lower high, lower low, and yeah, these are lower high, lower low, bunch of consolidations. All these things are all consolidations. So what the price did here, price came and swept liquidity. So remember the first thing, price swept liquidity. After the liquidity sweep, it break a key structure, which is the last higher lower high, right? It break a key structure, which is the last higher lower high. So we are having two criteria. Let's clean this up. We are having two criteria: as one, a liquidity sweep; two, a break of structure. Now, the next criteria we are looking for is we want to see if now what I would have done is I want to mark this range here. But before I mark this range, I will look to see this range I'm about to mark. Is there any liquidity inside this range? Specifically, the liquidity must be at below 50%. Like if you are to draw this thing from this low, okay, let me just get rid of this thing. If you are to draw this 10 from this break of structure all the way down to this point, that liquidity that I'm looking for must be below this 50%. Notice where I draw this range from. Don't worry, this is going to get, you're going to get used to this thing as we trade. I draw this thing from this where the break of structure occurred. In this case, it's a market structure, but where the break of structure occurred, I draw this range from this place to this swing low that was put in. So I want to see that there's a liquidity resting at below 50% of this range. Now, remember, this is the swing structure I wanted to mark out. I wanted to mark out this swing structure from this high to this low. This is the swing structure I wanted to mark out. But now, as I was trying to mark this swing structure out, I said, let me see if there's any liquidity at this point that is below 50% of a range marked from the break of structure to a range marked from the break where the break of structure occurred all the way down to the swing low that is put in. Is there any liquidity that was formed? There's no liquidity. So since there's no liquidity, what are we going to wait for? We are going to wait for liquidity to be formed. Now notice what price did. Price came and break the next structure. After price break the next structure, right? What do we now have here? We now have one, liquidity sweep, which is the criteria we are looking for. Liquidity sweep one, two, break of structure. Now we have this will now serve as our liquidity, our internal liquidity, which is the three criteria we are looking for. Why do I take this internal? Remember, this internal liquidity is sitting at below 50% of the range mark from the way the break occur all the way down to the swing low. You can see this liquidity sitting there. So now where will our range now be? We can now mark this low as our swing structure low. We can mark this high as our swing structure, as our high, the high of our swing structure. This becomes our protected low, and this becomes our low resistant liquidity run, the place where we are expecting price to easily take out. So we are expecting price to gravitate towards this upside. So now, if we are to mark our premium and discount of this our range will be from this low to this high. Let's use this one. Let's just use this one. So these are premium and discount. So once again, notice something, I added one more thing, verification checklist, which is to make sure that this thing is at below 50% for bullish scenarios, but for bearish scenarios it will be above. So what do I mean? Let me get rid of all this and explain this thing once more so this thing can make sense. So this one setup, what do we have here? The first thing we are trying to mark our range. For us to mark our range, we see that price is in a downtrend, and this was the last um, lower high price formed. So it's a key structure. This is also a key structure. So notice what price did here. Price came and swept liquidity. After price swept liquidity, a NAM break structure, a key structure, not just any key structure. You can see that there are lower time frame, there are minor structures here. To pay attention to the key ones. This is where the break of structure occurred, not all these minor structures. So what do we have here? Price swept the liquidity, then break structure. The next thing we want to look for is the next thing we want to do actually is to mark that place where the break of structure occurred, that swing low that caused the break of structure. Mark it all the way down to the swing, that swing high that caused the break of structure. Mark it all the way down to the swing low. Then you want to check to see this range you are about to mark. This is our range, this is our swing structure we are about to mark. Is there any liquidity that is at close percent that is below 50% of this range you are about to mark? Is there any internal liquidity here? Okay, let me explain this in a term that you guys can understand. After we saw our break of structure, our liquidity sweep, and a break of structure, for us to mark our range, we want to make sure that there is a liquidity sweep that is in that range we are looking to mark. Because I told you guys that my range incorporates liquidity. So my range is not just the normal range you guys are used to, which is something like this. I want to see liquidity. I like to add liquidity context to it. I want to see liquidity sweep, and um, also we see liquidity takeout. I don't know what you guys understand what's them. So now after we saw this liquidity sweep and a breakout structure, we want to look to see, is there any liquidity resting that is inside that our range that we are about to mark? Because of this is the range that I was about to mark. Yes, this will be the range I was about when price formed this peak. This is the range I was about to mark. But before I mark this range, I'll go back and see, is there any liquidity around this place that is at this range I'm about to mark? And some of you might say, yes, yes, obviously there's a liquidity at this point. Yes, it's valid. No, I don't just mean any liquidity. I mean liquidity that is below 50% of which range? The range marked from where the break of structure occurred all the way down to the swing low. So I want to see that there's a liquidity resting below this 50%. And in this case, we had a liquidity right here, but it's not below this 50%. So since there's no liquidity in this range, we need to wait for liquidity to form. So what the price did, the price came and break the next structure. Price came and break the next structure. Retrace, break the next structure. So as price break this next structure, now our criteria is complete. We now have a liquidity sweep. This is a liquidity sweep, not a break of structure. Why do I call this? This is a liquidity sweep. Now we now have a liquidity sweep, a break of structure. Then this is now that liquidity that we are looking for that should be inside the range. So all criteria have been checked. Now we can now mark this low to this high as our swing structure. So from this low to this high is our swing structure. And this is called our protected low. And this is called our low resistant liquidity run. Does any of this thing make sense? So if I want to draw my premium and discount, I can draw my premium and discount from the low to the high. So if you are looking for short setup, let's say you're looking for short setup around this point, you should be looking for short setup only above premium. But once price does this thing and come all the way down to this place, you need to be skeptical. And above this place, you can be looking for long setup. But when price come above this place, you want to quit looking for this thing. So this is how to map out your swing structure, and this is how to map out your daily range, your Fibonacci or your premium and discount. Yeah. So notice something. This now gives us our range, the area we need to focus on. I don't care what is below this, behind this place. Only what I care is from this place all the way to this place. That's only what I care. And this is for the bullish example. Now, I know this is going to be confusing. I would have just left you guys without a bearish example, but since this is going to be confusing, we're going to talk about the bearish example, and through the bearish example, it will also comprehend this one and complement this one, so you guys can easily understand what I'm actually talking about. And let's go over to the bearish example, and let me explain the bearish examples. For the bearish example, what am I looking for? Now, let's say we are in the let's say market is bearish. So what are we trying to do now? We are trying to mark a bearish range, a bearish swing structure. I don't know why I like calling it range. If you want to call it range, it's okay, but I like to call it swing structure because of, I don't know, it makes more sense. So let's say we are trying to mark his bearish swing structure. Now, let's say price is in downtrend, forming something like this. So price does something like, the first thing we are looking for, you want to see price form sweep liquidity, then next break structure. Okay, let's say it does something like this, break structure. So now let's extend this a bit. So now, for us to mark, for the criteria for us to for our range, for us to frame our range, we want to see one, a liquidity sweep followed by a break of structure. Now, when we get this thing, we want to see, is there liquidity? This is what I want to mark. This is the range I want to mark. From I want this is the structure. I want to mark this low to this high. But before I mark this low to this high, I want to see, is there liquidity in this range I'm about to mark? Is there liquidity? And not just any liquidity. The liquidity that I'm looking for must be 50%, must be above 50% of a range drawn from where the break of structure occurred all the way to the swing high. So we are looking for liquidity sitting above this point that is in this range. So notice something, there are two criteria. Number one, we are looking for us to mark this our range, we are looking for obviously, no, sorry, there are four criteria. Yes, the first thing is a liquidity sweep, the second thing is a break of structure, the third thing is that we want to see internal liquidity that is inside that range we're about to mark, and the liquidity must be sitting above 50% of the range drawn from where the break of structure occurred all the way up to this point. So in this case, we had it. This is it. So now this becomes our, let's get rid of this. So now this becomes our swing structure. From this high to this low is now our swing structure, our area of concentration. So we can decide to mark the low. This is our swing low, and this is all the way, this high is this end. So this is where we are interested in. We're only interested in any price around this place. If you are looking for other blocks to trade, we're obviously interested in this other blocks around this point, around above 50% and below 50%. All right, so yeah, what do I want to say now? If this is now our protected high, and this is our low resistance liquidity run. So we are expecting price to do its thing, and this is the place we're expecting price to take out. So if you want to mark our premium and discount, we can decide to mark it from this low to the high. So these are premium and discount. Anything above is premium, anything below is discount. If you're looking for sell setup, you're looking for it around this point, buy setup around this point. So now let me look for bullish example, a bearish example, or live chart example, so I can explain this thing for you guys, and then we'll call it a day. All right, so this is the bearish example we are going to be looking at. So there are two bearish examples here that we're going to be looking at. Yes. So let's start with this one. Now notice something. the first thing you can notice is that price is in a downtrend, forming lower lows, lower high, lower lows, lower high, and then price did what? It break structure. So let's start from here to explain what we are looking at. So now we are trying to mark our range. We can see that the first thing we had is a liquidity sweep. Second, we have a break of structure. What is wrong with me? And the next thing we want to look for is, after this break of structure, we want to look for and price from this peak. Normally, I want to draw my Fibonacci, or draw this, mark this high as my swing high, and mark this low as my swing low of this my swing structure. Mark this high to this low as my swing structure. But next thing I want to look out for, but I have to look out for one more criteria. Is there liquidity that is in this swing structure that I want to mark? And there is no liquidity. So since there's no liquidity, I will wait for liquidity to be formed. So now notice what price did. Price, let's mark this one out, is a liquidity sweep. So notice what price did. Price came and break the next structure after giving us the next break of structure. This high now serves as our liquidity. Then we can now mark this low, this high, and this low as our swing structure. Right? I hope you guys are understanding. This high becomes our protected high. This low becomes our low resistant liquidity run. So we can now map, if we are to draw our premium and discount, we can draw our premium and discount from year to year. Anything above 50% premium, anything below 50% discount, we always want to be selling at premium, buying at discount. Now let's look at the next example that happened. So notice something. After price did something like this, we had a new swing structure that was formed. Why? How is that? The first thing we have is a liquidity sweep. After this liquidity sweep, we had a break of structure. This break of structure occurred at this point. When this same break, we have a break of structure. Now, we are going to go back and ask ourselves, this is when price from this peak, this is the range we are interested in. This is the range we want to mark. We want to mark this low and this high as our swing structure. We ask ourselves one more question. Is there internal liquidity resting that is in this range that we are about to mark? And in this case, there's obviously an internal liquidity at this point. And just one more thing, this internal liquidity must be above 50% of the range drawn from the break of structure all the way to the high. This is the 50% is above it, so it's valid. Now we can now mark this as our swing structure. This is our swing low. This becomes our swing high. Our swing high is our protected high, which is the same thing as that high that swept liquidity. Our swing low is our low resistance liquidity run. So if we are to draw our Fibonacci or premium and discount, we can draw it from this place all the way to this high. Anything above is 50% is premium, anything below is discount. So I hope you guys understand it. What I want you guys to do for me is to go and I want you guys to go and mark out this range. I want you guys to mark out 2 during range. Go to your chart any time frame and try to mark out your 2 during range. Right, I'm already seeing another one. As you can see this one here. What do we have here? If you're to go to the lower time frame, this is an expo. You can see liquidity sweep. Then we can see break of structure around this point. If you have to go to the lower time frame, this is how this one will be. You can see break of structure. Okay, break of structure at this point. So from this, let me just zoom in for you guys. So from this swing probably didn't have any liquidity. So since this swing doesn't have any liquidity, we're going to wait for the liquidity to be formed. So price now break the next structure. After price breaks the next structure, this one now serve as our liquidity. Now we now have all our criteria: liquidity sweep, break of structure, internal liquidity. Then this low till this high is now our swing structure. Now this, since this is bullish and this is the low that spread liquidity, this low becomes our protected low, is a place we don't expect price to trade out of. And this becomes our low resistance liquidity low, because it's a place that we expect price to trade out, trade to. Now, if I'm to mark my premium and discount, I'll mark it from the low to this high. If I'm looking for any setup, I will be looking for bearish. If I'm looking for bearish setup inside this range, maybe bearish lower time frame setup. Let's say price start doing something like this. When it's in discount, it's safe for me to look for bullish setup. But once it's plus premium, I don't want any bullish setup. I'll start looking for bearish setup. If I'm trading the minor structures of this major structure. So this is what I want you guys to do to me as your assignment. Just go to the chart. I want you guys to test the water, and you're going to come up with a lot of questions and confusion, and I will answer it. Post it in the group, the chat room, and I'm going to answer it. Yeah, so next one we're going to talk about liquidity, because of, remember, we incorporated liquidity. This is our liquidity points. Yeah, I'll see you guys around.